Trading with our indicators and alerts is meant to be very straightforward. Our goal is to remove any guesswork from your trading, to make you not miss any setups that you want to trade, and to massively reduce your time spent in front of charts. And we aim to make this as simple as it can be. Step 1, an alert appears in the IRL alerts channel, signaling that a lower time frame is rejecting a higher time frame's IRL. Step 2, you check if the alert should be traded. And step 3, you set up your rejection alert indicator for an intraday entry, or you place your swing trade entry directly. But how do you know if the alert should be traded? Well, that is exactly what this video is about. The missing piece. It is not enough to simply watch this masterclass. I want you to use this video to build your own solid rule-based trading plan. I want you to click pause 100 times to take notes and to define your own set of rules that will stick with you for the rest of your trading career. Working through this masterclass once will probably not be enough. Rewatch it 2 times, 10 times, or as often as you like, until you extracted every important piece of information into your trading plan. Hang it to your wall or stick it to your screen. Every trade you take, make sure you follow your own set of rules. A year from now, we want you to be able to look back to this day and say, that was the day I became profitable. So pick a pen and paper or open your notes app and get to work. Oh, and have fun watching.
All right, so we can all get started right here. Feels back like a uni lecture session, right? I've never used Google Meets. This feels like I'm a professor right now. But all right, so what we've done here today in this little webinar, masterclass, whatever you want to call it, I've organized some tickers to review, going over some very frequent questions and scenarios in price where I think can be extremely insightful for you guys to know in order to properly use the indicator and maximize it to its full potential. We're also going to be going over the pillars of my strategy, how I view price. So that way we're all on the same exact page when viewing price. There's no confusions, there's no misunderstanding as to why the indicator is doing this, why is it marking that, but not the gap here or below it or above it, why is it deleting this gap? If we understand the way we view price, the way I trade, the way we do our top-down analysis, you will be able to utilize the indicator to its full potential. All right. So let's make sure everything's on right here. Let me delete all drawings and get into it. So the pillars right here. The first thing we want to do when looking at charts is to come to a bias. And we're going to start on Bitcoin right here to break this down. We want to come to a bias. What is a bias? A bias is simply, are we bullish or are we bearish? 1 second. Let me make sure this is correct. Okay, so simply said, are we bullish or are we bearish? Are we going higher or are we going lower? And the way we can determine that question is by using the fair value gaps. Where are they pointing? Well, if we take a look at Bitcoin, we're pointing higher. And we want to start our bias. We want to get that answer. We want to start looking for the answer to that question, the bias, on the monthly chart. Every single time we sit down, look at our pairs, get ready for the week, want to do a top-down analysis, or even want to trade any pair, we want to start at the highest time frame because the highest time frame will affect everything down to the 1 minute. So you cannot ignore all the time frames, even if you're a 1 minute trader. You need to know what the monthly is doing. So we want to start our analysis on the monthly to get that bias. So very simply said, which way is the fair value gap pointing? Pointing higher. This fair value gap creates what is called an order flow leg, a high probability order flow leg, which is what this indicator is pretty much marking. This IRL to ERL indicator, what is it marking? It's marking high probability order flow legs. What makes a high probability order flow leg up? A swing low to swing high with a fair value gap in the middle. Now you may be wondering, but there's no swing high right here, right? Because what makes up a swing high? A candle that has a candle lower to the right and lower to the left. In a scenario like this, we can still view this as a swing high, or better yet said, ERL, by just using the previous candle's high. So at this moment in time, for example, there's no swing high marked, but we can still consider this point right here the ERL level. Right? We don't have to wait for the third candle to close, form the swing high, and then we can use this as valid. No. In this single candle, price can come down and then move up higher, which is what it did right there. See, we don't need to wait for that third candle to form. A common misconception, I believe some people have. All right, but once we have our bias, we're bullish. We have an area right here signaling bullish prices. Hey, great. Let me delete all the drawings again. And actually, let me go mark this up because context was already complete here. And what the indicator will do, I believe this is a bug that we haven't found a solution with, where once the context is complete, you won't see that on the monthly because the monthly fair value gap will still show. Once you go to the daily, we're able to see that we came into the gap and completed that context. So that's why I'm manually drawing the monthly fair value gap right here in order to continue with the example, because the indicator deletes it once context is complete, right? So bias. Okay, so we have our bias, and let's go back in time to over here where we haven't traded back into that yet, which now the indicator will actually mark it, so that's perfect. Bias. Okay, great. Now we need to know narrative. If we're going higher, where are we going higher from? Well, in this scenario, it was quite simple, where we're going to go higher from the monthly fair value gap. But there's other scenarios where we can use previous candles lows, previous candles highs as a bias, and then we're going to have to go into lower time frames to then confirm a narrative. If we're going higher, where we're going higher from, which we'll get into example. Maybe I can just show you real quick so you're not scrambling in your head. I believe we had one on Euro JPY where we swept previous month's low. If we're going to push higher, we're going to look for a narrative inside this candle, right? We're going to get into that. Don't worry. We're going to get into that. But going back to BTC, when we have a fair value gap right here, we already answered the bias and we answered the narrative. Where are we going higher from? Great. And now we have context as well, because context is essentially narrative plus your target, which is just IRO to ERO. Right? So context is narrative, except once we consider context, context is the boundary we can operate within to look for entries, where over here, the boundary is from that fair value gap to that swing high. Within this area right here, let me go back. Within that area right there is where we're going to look for our trades. All our long setups are going to form in this area right here. This is the boundary. We want to dive into the lower time frames to look for our setups, our impulse shift, or fair value gaps. This is where all our properly aligned PD arrays are going to hold. Your order blocks, your swing lows, they're going to hold right here using proper time frame alignment inside of this boundary. So that's the context. The narrative is simply where we're going to push higher from, which would be this monthly fair value gap right here. All right, so we have a bias, we have our narrative, we have context. Now we need our entry. And if we're swing trading, our entry can simply come in the form of 4-hour fair value gaps or 1-hour fair value gaps. Now, this leads me into the discussion of time frame alignment. Oh, and I just realized I deleted the little drawings I had over here. But if I remember correctly, it was something about fair value gap change. So something that we can do regarding the time frame alignments and what's going to be a new addition to the rejection alert indicator, which is right here, a new update, is that we're going to be able to get alerted for fair value gap change. So what is a fair value gap change? Well, I'm sure most of us here know from a monthly, we want to be looking for a daily fair value gap, a daily impulse shift. Cool. But what some of you may not know is that you could also look for a 4-hour entry off the monthly in the form of a 4-hour FVG chain. Meaning, from this monthly gap, rather than waiting for the daily, you have another option. You can dive down into the 4-hour, wait for the 4-hour FEG chain. And all that is a fair value gap out of the monthly, which creates a new fair value gap, right? So pretend this is the monthly. We pass up on that first 4-hour fair value gap. It's not ready just yet because now we're diving down into a much lower time frame than the daily. So we need more confirmation because we're going lower in time frames, right? So we avoid the first 4-hour fair value gap. That's not enough. It's not ready. We wait for that to create a new fair value gap, a new 4-hour gap, giving us a chain of 4-hour gaps where a 4-hour fair value gap created a new 4-hour fair value gap. This right here can be your entry. So you have two opportunities here to confirm price wants to move higher. You can wait for the daily, that's fine, or you can go to the 4-hour, right? So now let's see how that played out on Bitcoin, which would lead us into the entry. So let's wait for the thing to load. Okay, sweet. So now we're just waiting for price to sting into the monthly fair value gap. I'm just going to play right here. All right, so right here, 4-hour fair value gap gets created. We don't want to trade that. We're waiting for a new 4-hour fair value gap to respect and create a new gap, giving us the chain, which we will see shortly here. So there's your 4-hour gap, price retraces. We want to see a new expansion off of that. All right. And there's your new expansion. There's your 4-hour fair value gap chain. You got to mark that up. I'm sure the indicator will do here shortly. And there it is. There's your 4-hour fair value gap. Now this right here can become your entries. So what do? You can enter right there. Whoa, why is my thing like that? Yo, why is that so high up there? Let me fix that. Those are that 1 million R trades.
I think Dina had the same problem earlier. Must be a bug on TradingView today.
Yeah, I've never seen that before, but all good, all good. But yeah, there's your 4-hour fair value gap entry. And what you'll notice is prior to that getting tagged, we notice that what gets created right here. Let's look very closely. This is very interesting stuff. We have a daily breakaway gap. All right. While we don't expect price to retrace down into that daily, the possibility is still there. So if you're going to take a 4-hour entry right here, your stop loss should take into account the fair value gap below it, because while it's not expected, it can still happen. And how much of a shame would it be if you got bottom ticked just the price to continue higher off that daily back? It would suck a lot. So you want to cover it. And what I did here for my trade right here, I did take this. I covered that daily breakaway gap. So below it, I gave a little more room, put out a relevant swing point right there. Just anywhere is really fine around here, just covering the daily bag, giving it the opportunity to trade and then still reject. And then from there, target is static 2R. And there's your entry. Simple as that. Right, taking into account that daily bag. So let's go back up to the daily time frame. What you'll notice that this is that daily breakaway gap. So what I really sick feature about the indicator is that it marks out these higher time frame fair value gaps for you. So you're not blindsided when you get a daily bag lower. You know from watching the 4-hour right here that, oh, look, a daily breakaway gaps get created. Let me cover my stop in the scenario that price does want to retrace down to that daily bag. I need to cover that stop. I need to cover that daily bag. It has to be covered. The stop loss right here at the swing low, which creates this leg, that's not the correct stop loss in a scenario like this where we have a daily bag right below that. That is not a safe stop loss, all right? So you want to cover that. Very important to understand. So that is how I approach this specific scenario right there.
Sorry to interrupt, Pickle. Can you change the transparency of your position? It's almost not visible on the screen share.
Oh yeah, so this long position tool, you mean?
Yeah, just a bit more opacity because we can barely see it.
Could
Thanks.
do for sure. 13. All right, is that better, guys? Should be good.
Yeah, no, it's better.
All right, sweet. Sweet. So yeah, then we are now in the trade. Now, how are we going to now manage risk? This leads into step 5, right? This pillars right here leads you all the way from top down to your entry to your trade management, your risk management. All right. Let's enable the stop loss indicator right there. Now, what is going to do, what this is going to alert you on, what this indicator is going to alert you on is when we get a new order flow leg higher. Because when we get a new order flow leg higher, for example, if we got a new 4-hour gap right there, this low is now your protected low. So you can move your stop loss up there now, because now we're respecting that 4-hour gap, creating new gaps higher after that. We should respect that low. So if you want, you can trail your stop loss up to there, which we will see the indicator mark soon here once we get a 4-hour gap. So let's observe. Let's delete this, clear things up. So I believe that is where we get our new gap lower, and we'll see that stop loss get trailed right to here. Now, let's move a little forward in time. You could trail your stop loss right there. Once we get price action like this, so I have 2 ways I trail my stop loss, right? We have the order flow legs, like we saw right here, which the stop loss rejection alert indicator trails up, all right? But the second way I do it is based on proximity to TP. So when we have price this close to hitting our 2R, as you can see, it's extremely close. It's closer to hitting your 2R right here than it is to hitting your entry again right there. When we're very close to our TP, I like to go break even. Immediately, I'm doing this. I'm going break even, and I'm protecting my position, because what is super unhealthy and super unlikely, if we are truly bullish, to happen when we are this close to TP? Is that likely? Will that look great for our trade in terms of probabilities? Disrespecting this fair value gap, disrespecting this fair value gap, disrespecting this fair value area, coming back to entry and then going back up? Absolutely not. That is not something that we need to take into account. We want to go break even, because a scenario like this likely means we're seeking liquidity, and we could avoid taking a full stop at that point. So very important to understand, I trail my stop loss, this goes into 0.5, based on the order flow legs, which this indicator will mark out for you, and the proximity to TP. So for example, if we had a higher target like that, price came down, created a new fair value gap right here, a new order flow leg, this would trail up to there. You can trail your stop loss to that point, because that's your new protected leg, right? And that's what the indicator will do for you. And that's why you want to set alerts on that, right? You can set an alert by going here. It won't let me do it on replay, but on live price action, you will click the button, add alert on Discord or on the indicator, and you will get alerts every time this is trailed higher and higher and higher. So that is a textbook example of a trade setup on Bitcoin. I like to just target 2R. So for me, it doesn't really matter what ended up happening next, but this did go up. And as you can see, we had that daily fair value gap that price came and retraced into right here. Wait for it. Runtime error. Uh-oh. Just add it back up.
So can you hover above the error message? It happens sometimes that there's a calculation error. Then you just have to change time frame one time and get back. Then it works.
Oh, okay. Oh, I deleted it already. But yeah, good to know. Good to know. I just re-added it.
Yeah, if it happens, just hover over the red arrow icon there. Then I can tell you. But yeah, works now.
Okay, sweet. So what was happening over here? I think there was a 4-hour fair value gap that we disrespected because there was a daily below it. So let's go back real quick. is this goes into the topic of the higher the time frame for value gap, the more likely it is to get traded into, and how we need to cover those bags. So you see how now a new daily for value gets created here. If you entered something like this, you want to be able to cover that. You don't want to choke your stop loss. So we have a daily bag below. Price reaches for that daily bag, and then we continue pushing higher, completing context at the monthly highs. And now once context is complete, that's when you want to take a step back, because now what just happened on here on a monthly? We just completed context. So now let's go back to current price action. What do you do after context is complete? You want to take a step back, because now you just had an entire month, a whole monthly context. A bunch of days you could have taken advantage of that long bias. Now you want to take a step back and wait for new context to form. Because what usually happens is stuff like this, where now the market's uncertain, we're consolidating. If you wanted to continue higher, truly, well, we would have likely displaced over that, create a new fair value area, and then we can continue looking for longs. That's not the case. We swept it, came back, and now you want to take a step back, expect that consolidation. These are all low probability conditions you want to avoid right there. Right. So that is Bitcoin, and that is a simple walk down of the pillars of top down, from going top down, starting with a bias. Are we bullish or bearish? Going into a narrative. If we're going higher, if we're bullish, how can we actually reach our bullish targets and move higher? Well, that's when we look for a PDA rate, fair value gap we can move higher off of. Saw it right there. That's our narrative. Also our context. Great. Entry, we went into the 4-hour fair value gap chain entry. We understood that there's two ways we can confirm prices moving higher of a monthly. We can look for a daily, or we can look for a 4-hour FVG chain. And then we went into the 4-hour FVG chain entry, went over risk management. How do we manage risk? We want to trail it based on the order flow legs or in proximity to TP, which my TP is always a 2R. So that was a nice walkthrough of all that right there. So we're done with Bitcoin. We can remove that. Let's go on to the next examples that I have marked right here. Did all my drawings delete? Okay, no. I had little notes up here, which I don't see it on gold anymore. I believe what I was going to go on gold was, what was it? I believe it was the setup that we had earlier this week. Let's delete that. So in terms of bias, where are we likely reaching to? Well, at this point in time, this candle was starting to reach higher. I don't know if you guys saw that video I sent earlier in the trading together chat. I sent a video outlining why this is low probability conditions, because of how this candle is failing to expand higher, and how we don't just look for a random daily fair value gap displacing in here just because price came back into that monthly breakaway gap or fair value gap. Because once price taps into a fair value gap, I consider it mitigated. It's already used up. It has a chance to push higher right here. If we don't do that, that's very suspicious. So if we still do want to end up pushing higher off of this fair value gap, I need more confirmation, which is what we saw going into the daily right here. I outlined in that video, which it is pinned, I believe, if you have no idea what I'm talking about. Echo? Who's echoing? No echo? Okay, I think we're all good.
I don't hear an echo, but many people do. I don't know where from. Everyone mute yourself, please, if you don't have it.
Yeah, please mute yourself, guys. I don't hear echo on my end, though, so I think some of the majority of us are good. From Sir Pickle? Really? No echo. All right. My audio is perfect. All right, we'll just continue on. But yeah, if you have no idea about the video I'm talking about, it's pinned in Trading Together chat. All right, so please check that out. It's a video outlining gold and why I was avoiding this right here. Let me see. Maybe my notes are on gold. Is it here? No. All good. I'll try to remember what I was going to say here. There's a few talking points. So we have this fair value gap right here. Why is this low probability? Like I just mentioned, we had our chance to push higher here. Boom. Why did we not push higher here? We disrespected all these fair value gaps and we got into low probability conditions. How can we identify low probability conditions, and how can we identify once we are out of them? This is important to understand. So how can we identify we are in low probability conditions? That is when bullish and bearish, both bullish and bearish fair value gaps, are failing to follow through. So as we can see here, well, these bullish fair value gaps failed to follow through, creating a bearish fair value gap. Okay, will this bearish fair value gap follow through? It did not. We have bullish fair value gaps again. Okay, it did not. Bearish fair value gaps. Did they follow through? They did not. We are in low probability conditions. Nothing is following through, either to the upside or to the downside. So it's also another thing a lot of people do wrong is once price comes back into this fair value gap, any first fair value gap to see out, it's not valid. This isn't a fresh PD array, a fresh context. We already used it up right here. So this right here, it's not something I was looking at. Regardless, in hindsight, if it worked out, that's good. That's in fact what we want to see to get out of high probability conditions. I want to see this respect, but I don't trust it until it actually happens, right? This is what's called the trust test. Look to the left. What have the fair value gaps been telling you? How have we been able to trust them? No, 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 no follow through. So why the hell would we trust out of nowhere all of a sudden this daily fair value gap right here? It makes no sense, and it's low probability, regardless if it played out. In fact, like I just mentioned, we want to see it play out. We want to see it create expansion because that is how we get out of low probability conditions. When you have a discount array, disrespect the premium array in the form of that swing high, discount array in the form of that fair value gap, creating new fair value gaps right there. That is when we have confirmed bullish order flow again. Fair value gap respected, creating new fair value gaps higher. Now we're in high probability price action. So look at this. Look at this right here. Low probability, high probability. High probability IRL to ERL. Look at the textbook respect right here to your overlapping levels, to that order block overlapping with the fair value gap, the textbook respect candle. Look at this high probability IRL to ERL, textbook respect candle and follow through. High probability, low probability, low probability, low probability, lower probability because it hasn't been confirmed yet. We're shifting order flow, but we haven't confirmed it right here. It's coming out of nowhere. This fair value gap came out of nowhere, whereas this fair value gap, it came out of here. Okay? It came out of a relevant level. This I wasn't looking for. So I hope that makes sense and why this is high probability, how we were able to wait and sit out all this low probability price action right here and then resume back onto that high probability price action right here because we saw respect to fair value gaps again. Because the primary reason, the primary objective of a fair value gap is to create a new fair value gap, to create new expansion. So when we see that, that creates a high probability gap. When we don't see that coming out of nowhere in low probability conditions where fair value gaps have not been respected, we can't trust these. We can't confide in them. Well, that makes a low probability context. Like here, again, you may be wondering, but it played out. It doesn't matter if it played out. That's what we wanted to see to get out of those conditions, which we confirmed them right here. And now we can play textbook context, right to the monthly swing high. So that is beautiful. Beautiful. But in the high probability, does it matter to tap also the overlapping array? Question from Arafati. In high probability, yeah, it's totally fine if it taps the overlapping array. That is a valid line of defense. We don't know which line of defense price will move higher off of. We're waiting for the confirmations. On the lower time frames, you'll see 1 hour fair value gaps, for example, shifting, 1 hour fair value gaps shifting, impulse shifts. And then we know when price is in a confirmed buy program on the lower time frame, right? Buy program in the sense that it's in a market maker buy model, which if you're wondering what a market maker buy model is, a lot of people on Twitter like to really complicate things. Stage 2, stage 3, silver bullet. I keep it very simple where a market maker buy model is simply the movement from a PD array to a PD array. So right here, PD array to PD array, IRO to ERO. And this fair value gap with an overlapping order block to this swing high. PD array to PD array. market maker buy model in here is confirmed once you get your 1 hour impulse shift, your 1 hour fair value gap displacing away. I already arrow, fair value gap to swing high. Push context is what I like to call that. You're going to find your market maker buy models in this area. On your properly aligned time frames, that is where all your order blocks, your fair value gaps, your swing lows are going to hold. Your 1 hour, for example, 1 hour PD rates. And once we get a 1 hour fair value gap displacing out of that daily, that is a confirmed buy program, market maker model commenced, and we can seek the premium array right here, that external range liquidity. Simple as that. That's all a market maker buy model is. Can the indicator confirm that? That's exactly what it does. That's exactly what the indicator does. It confirms, first of all, it gives you your context. And then if you go down to lower time frames, for example, over here, a beautiful example, probably one of the best examples I've seen in a while. Let's go over here. Here's your daily context, which the indicator should mark. I don't believe I have to mark this out right now. Oh yeah, no. So here it happened again. So runtime error.
Yeah, that's just a calculation error that happens sometimes because the script is very big. And if that happens, just switch time frame, switch back, and then it works.
All right, sweet. Let's see.
Sometimes you have to do it twice, but it will work, I promise.
Okay, there it is. There it is. All right, so there's that daily fair value gap. So let's delete in the drawings right here. There's your daily fair value gap. And let's see. I want to show the ERL line before IRL is tapped so I can understand where the context is we're working with right now. So that's why I just turned on that setting. I like to have it on. So let's turn it on. Let's turn off the days right here. I just want to keep it very simple to price action. Nice clean chart right here. So what do we have? We have our context now. We have narrative, meaning if we want to push higher, where are we going higher from? This daily. Awesome. Context. From PD array to PD array. The boundary, we can work with it. Well, now we have our daily IRL, daily ERL. So for your highest probability trade setups, you're waiting for price to come into this level, give you the fair value gap out, the impulse shift, which the indicator does mark, to then target higher. And that is when we confirm our market maker buy model, once this right here happens. All right, so let's wait for that retracement into the gap. All right, beautiful. Now this goes into, let's wait for the fair value gap to get created right here actually. And boom, there you go. There's your 1 hour fair value gap out of your daily, all marked by the indicator, also overlapping the overlapping line of defense right there. This order block also, what do we see? It's a unicorn right there. It's a breaker. Swing low, swing high, lower low, displacement through the breaker. So that's beautiful. There's a lot of confluences here. Not only that, what is this right here, which is a new update coming. It's what we call a rapid impulse shift, or RIMPS for short, if you want a funny little abbreviation right there, a RIMPS, a rapid impulse shift. Credit Nils for that name. He came up with that. We have a fair value gap displacing into the higher time frame context, followed by a fair value gap displacing out. Cool. But when they're overlapping, like that, portion of it's overlapping right there, that is what we call a rapid impulse shift. It is extremely high probability when you see that confluence, when they're overlapping like that. If they're not overlapping, it's still high probability, it's still an impulse shift. But when they're overlapping, we can consider that a rapid impulse shift, and this is extremely high probability. It boosts the probability significantly, right? So that's very great to see. On top of the fact that we have a unicorn right here, just a lot of arguments for this to work. So really, really nice right here. You can set your entry right here. Oop, it happened again right here. Let's see. Yeah, no, it happened again. How do I fix that?
I didn't pay attention. What?
The thing happened again. The position tool. Did you say there was like a
that's not me. That's I have nothing to do with that. That's just TradingView being weird today.
Oh, okay, yeah. Okay, well, I'll just delete that. You guys get the point where you want to enter right here. Actually, let's turn on the stop loss indicator and set potential entries, because it'll also show you potential entries. You can open up where it says all. This is going to be the only entry right here that we have pretty much. Now, when do we want to use the wicks versus the bodies? I know this is a question someone sent me. When do you want to use the wicks versus the bodies? Well, this is a pretty good example. When you have extremely large wick like this, that is when I will opt to use the body. So I actually really want to use this tool. So I'm going to just manually scroll to the heavens here. All right, it's fine. I'll figure it out later so we don't waste time here. But we can use an inverse scenario right here. Let's just inverse the colors right here. This is long, this is just short, all right? You can enter right there and you can target this is gonna be tough to work with here actually, it's backwards. Target a 2R. We all know I like to target a simple 2R. Entry will be at the open of the fair value gap right there. Stop loss, what we were discussing, where can we put it? The bodies or the actual low? Both are valid. But scenarios where I actually use the body is when we have very long wicks like this, where the RR would make you be targeting really far above. And it wouldn't make sense for the price to sting this deep anyways, right? Essentially, in a nutshell, when you have long wicks, I like to put them at the bodies. When you have a very short wick, I will just put them at the wick itself. But long wicks like this, I will opt for the bodies to save some R right there. Because if we're going to go down there that deep anyways, we're likely going to just seek liquidity. If at that point we would be failing to offer fair value, failing the unicorn, failing the gap, well, now that's flip context, which we're failing to offer fair value. We're likely going to seek liquidity anyway. So to save some R right there, I just put at the bodies when you have very long wicks, right? So entry, you can put your stop loss there. If you saw my execution on there, I personally put it somewhere a bit higher. Again, that comes with more screen time, more experience, more understanding of price. It's a bit hard to explain that in a mechanical way. That's where you have to lean in your intuition, where I believe the biggest leaps in your win rate and what separates you as a trader from the rest is that intuition, because anybody can trade a mechanical strategy. It's that 20% intuition, because 80% can be mechanical, but you want to have 20% intuition where you allow yourself to use that experience, use all that screen time and knowledge and put that into play. And that's where you see the biggest increases in win rate and separate yourself from an average trader to a great trader. So for me, I place my stop loss somewhere around here, just a little bit higher, understanding that, well, some of the reasons for that is, well, if we're going to come disrespect that fair value gap, that's already a bad sign. We're going to disrespect this order block and this breaker, that's already a bad sign. If we're staying this deep into a fair value area, well, that's already also a bad sign. So do I really think this is high probability at this point? I think my stop loss was somewhere like here to continue higher. Not exactly. I mean, it can happen. We can wick. Overall, it's very low probability based on how many confluences are in this. So that's why I opted here. But as a rule of thumb, keep it very simple for you guys. You want to place it at the low that creates the gap or the bodies that creates the gap, right? So, edit manually. You can double click the P&L and manually place the price closer to P and move it to the exact prices. Whoa, yeah, what is happening there? There we go. Thank you so much for that. Wow. Thank you. Shout out to Trainelius. There we go. Yeah, now we have it. That was very simple, actually. So yeah, and let's see how this played out. Actually, let's put that there. Let's say we put a stop loss right there. This is actually also something I want to talk about. What to do when you're targeting so high up above context, right? Because the higher and higher you start to target above context, the lower and lower the probabilities become of your trade actually hitting TP, right? Because if we're working within context, that is the highest probability trade. Once you start targeting above context, the further and further you start going above it, the lower and lower the probabilities are that your TP actually gets hit. All right. So this is the reason why I always say, in case you didn't know, why I always go break even once context highs are taken. So for example, if you were to take the setup like this, you put your stop loss at the wick body. So for example, like this, the body, it should upload it right there. If you took your trade setup like this and you get tagged, price hits context highs. That's a bit too fast, brother. Let's go back. I don't believe I'll be able to show it perfectly, but once this candle starts trading like this and we reach that context high, at that point, you're going break even. Boom. You're going break even once context highs are complete. All right? Because you're targeting above context highs. You are playing the boundary, the context between IRL to ERL. That is where your highest probability trade setups, highest probability chances of hitting target are going to be if your 2R falls within that. Once you start targeting above, the chances, like I just mentioned, decrease. And we could sweep liquidity or start consolidating or reverse. We do a lot, right? We don't know. We don't have that narrative anymore. We don't have that context anymore to work with, right? It's been complete. So now we're sort of just betting on the fact that this expands off of a previous fair value gap, which in high probability price action that can happen. But if we define things even more, from high probability fair value gap, if we define things inside that high probability fair value gap, inside that context, well, there's stages of probability within that. For example, the highest probability thing when we have context is to see a simple rejection out of that daily fair value gap, something like this, where we're just rejecting. The second highest probability thing, the next highest probability thing to happen is you get your actual entry pattern formed, which happens right here. So this would be the second highest probability thing to happen within high probability context. The third highest probability thing would be your entry actually giving you a winning trade, right? So better example would be if we were able to target 2R within this, that's the second highest probability thing to happen. If we were able to somehow target 2R within this, that's the third highest probability thing to happen. The fourth highest probability thing to happen in terms of the stages of probability is price actually reaches that context high right there. And the last thing, and what I would consider the lowest probability inside high probability price action is for price to actually expand above that context high, which is why if you're targeting up there, the chances of it getting hit are lower and lower compared to if you're targeting something in here. Right? There's 5 stages of probability within high probability context. So that is why we want to go break even when context highs are complete, because we don't know what's going to happen after that. We don't know. It can still continue expanding higher, but we want to secure our position in the event that it does it, because we can't, with high probability, guarantee that it wants to do that. All right? Very, very important to understand that. And that would pretty much complete your gold trade. This eventually did hit 2R. It hit that TP that we had right there. I deleted it, but it did hit your 2R right there. You were break even right here. Overall, you would have had a freebie once that context high is complete. And overall, a nice high probability textbook trade. Beautiful. So that was everything I wanted to look at on gold. Let's move on to the next thing. And I won't repeat that looped relaxation. I said a lot. You can be, Nils just said it. There will be a recording so you can rewatch that, slow things down, and get the whole gist there as many times as you want. All right, what was I going to say over here on oil? So we have the point of demanding more confirmation and avoiding an IRL alert. Okay, so this goes into when I demand more confirmation out of an IRL. Some of you may have heard, like me on streams or just talking, I'm going to demand more confirmation. I want to wait for more confirmation. When do I do that? You will find out after the break. All right, we're back, chat. We're back. So oil. So when to demand more confirmation? Well, I want to demand more confirmation when we are respecting an opposing unmitigated PD array through candlestick logic. For example, right here. Candlestick logic is essentially, are we sweeping? Are we running? Are we respecting? Disrespecting? Which can be seen through this candle right here, where we're not getting a candle body close above it. This is a significant weekly swing high. We're disrespecting it. Okay. And we're seeing a very aggressive retracement down into here, into this weekly back. So if we go to the daily, we will notice and see with more clarity just how aggressive of a retracement down into this fair value gap is. As you can see, we have a very large daily expansion candle low, which creates a potential daily bearish fair value gap, which, let's go back in time right here. Very aggressive sting lower. We go into the 4-hour. I believe the IRL alerts sent a alert that the 4-hour is rejecting, which I believe it is right here. Why did I avoid this one, right? This one right here. Let's go forward in time, see when that happened. That happened yesterday at 10 a.m. Let's move forward in time. Right there. That's when it happened. So at this moment in time, let's move forward. All right, well, it didn't create it because this next candle just completely annihilated that. But that 4-hour fair value gap was shown by the indicator as it was happening. Let's go back up to the daily. What do we notice at this point once this alert is triggered? Well, we can clearly see a very aggressive sting. We're respecting a weekly opposing unmitigated array, and we have a daily fair value gap to the downside created right there. Overall, it's going to act as an area of resistance that's going to pose some issues on the way up, right? Overall, I want to demand more confirmation here because I can't say with 100% certainty that I am 100% bullish right here. There are some reasons that are going to hold this up. There's very aggressive retracement. We are respecting a weekly premium array right there. Overall, I want to see more confirmations that price is going to go higher. Now, what do I mean by more confirmation? Well, that can come in the form of a few different ways. We can, of course, demand a new 4-hour fair value gap out of that old one. So this right here, when I saw that alert, when I was looking at price, I told myself, I'm going to demand more confirmation. I'm not going to take this. This is lower probability, right? And I'm going to avoid that IRL alert. And by more confirmation, I mean I want to see a new 4-hour fair value gap higher. Something like that right there. You can look for that or demand a fair value gap one time frame above what you typically look for. So from a weekly, you can also just look for a daily fair value gap displacing higher. It might take a little longer to form, but it is overall a better confirmation. So let's delete this. And overall, you can also just wait for daily gap or 4-hour FVG chain. All right. And that is because, in case you missed it, I'll just outline it again. Why would I demand more confirmation? Well, we're respecting an unmitigated opposing PD area right here and seeing a very aggressive retracement on the daily, creating daily fair value gaps lower. I want to wait. It doesn't look clear to me. It doesn't look ready. All right. Nils just mentioned alerts for the higher time frame rejections, weekly to daily, daily to 4-hour will be added to IRL alerts channel soon. So yes, that will be very, very useful as well. Those are also important rejections you want to keep in mind. And monthly to weekly, yes, because those are even stronger, right? A weekly to daily confirmation is even stronger than a weekly to 4-hour. But we just use the time frame alignments as minimums, right? We can always go higher because the higher we go, the higher and stronger the time frame is, the stronger that confirmation becomes. So that is a very, very nice feature we're going to add to the high time frame rejections alerts in the Discord. So that is oil. That is when I will demand more confirmation and avoid an IO alert. So we can move on. GU. As well, understanding the dollar to trade the majors. All right, so this is also something interesting, right? Let's see, what are we doing on the monthly? All right. First of all, it's very suspicious how we are respecting this monthly swing high like this, or swing low like this. Respecting a discount rate. All right, that's a bit of a bullish argument. We'll go to the weekly right here. We see a weekly fair value gap we're trading into. You may think, okay, weekly IRL to ERL. Inside of this weekly gap, I'm going to look for a 4-hour fair value gap. Right? Actually, let's go delete this. Let's go back to what's currently happening. I see a weekly fair value gap. I'm going to look for a 4-hour fair value gap displacing lower. And then you see that weekly 4-hour fair value gap displacing lower right there. Why would you avoid this? We need to understand the dollar. Well, actually, let me go back in time so we can actually see the indicator market, all everything, and what it looked like at this time. Because I'm sure some of you may have taken this because it fit a lot of the boxes where we had a weekly IRL to ERL, weekly context, 4-hour fair value gap lower. Boom, let's enter. Dollar at that time, it wasn't ready. Dollar was not ready. At that moment in time, dollar still had not traded into the weekly fair value gap that we are going to see down below price. Right? So if we're still bearish on dollar and expecting it to retrace into this weekly gap, why are we going to short euro? GBP. It makes no sense. If we're going to look short on GBP, but also expect short on dollar. Whereas once dollar comes to this weekly gap, that is when we can potentially look for shorts. But we have to see that happen, that rejection. How are we going to trade in there? Because currently on dollar, we're not respecting it for shit right now. And that's how you could have avoided that GU trade where it just dollar wasn't ready, right? You wanted to be understanding where dollar is, what is the bias on dollar to get your bias on all the majors. So that is how you could avoid what looks like a high probability setup on GU, maybe with that weekly context 4-hour fair value gap. You can avoid it by understanding the dollar is bearish into that weekly gap. How is it going to react at that weekly gap? Well, currently it's not reacting at all. In fact, this is looking quite bearish. We do have a monthly fair value gap down below. So just a quick dollar analysis. We have 7 days in this monthly candle. If we end up closing like this, we sweep previous month's high. Well, what becomes the next draw, right? And this is a very easy way to get bias using just candles. Well, what's happening to previous month's high? Because previous month's high, previous week's high, previous day's high, previous month's low, previous week's low, previous day's low, previous candle lows and highs are all premium arrays or discount arrays we can use to help us frame a bias and understand where is the next candle likely going to head towards next. So if we're currently respecting previous month's high and we're respecting it because we're not closing above it, showing large rejections over it and displacing back lower, we are respecting that. Where are we likely going to head towards to next? Because price moves from premium to discount arrays to premium arrays. So where is the next discount arrays? It would be his previous month's low, which would align with that monthly breakaway gap right there. Which, if we now start pointing lower, they can't really say that's a breakaway gap. It's a target now. All right, so if we're going lower, how are we going to get there? Well, let's go to the weekly. Weekly order flow is still bullish, but currently not respecting that at all. And if we're gonna now go into the daily, and we're gonna see daily fair value gaps start pointing lower. As we see right here, this is a potential new daily fair value gap. And if this ends up forming this monthly fair value gap right there would be the target. It would make the most sense. Because now, what would also be happening potentially on the weekly, we have a potential weekly fair value gap getting created. Once this week closes, you're going to have this candle close. Then the next week will likely create a weekly fair value gap to the downside, shifting order flow now on a weekly basis to bearish. On a daily, order flow is already bearish. On the monthly, we have that bearish bias because we're sweeping previous ones high. So there's more bearish arguments at the moment on dollar to be made. Okay? This is why if we get a daily fair value gap here, disrespecting this weekly gap, I will be looking short on dollar. And in order for that not to happen next week, this next weekly candle will have to trade up and tap that level. Why that level specifically? By the way, this level right here is just previous candle's high. And delete that just to show you more what I'm talking about here. This level right here is the area of negation, the weekly FBG negation. That's what I call these levels right here. Negation. Because price will have to negate that level in order to stop that weekly order flow from shifting. This being tapped next week will save the idea for longs, because if that happens, well, we have no weekly fair value gap. And now we're respecting this weekly fair value gap, to pushing higher, likely seeing daily 4-hour fair value gaps higher, removing the possibility of a bearish weekly fair value gap. It's likely at that point we do continue higher. But is that likely to happen? That's a lot of price movement to go up towards you, and that's a lot of daily bearish order flow, which we're likely to see here get created. So I'm not too high on that idea. It's a bit of a long shot. The arguments to be bearish are very heavy compared to the bullish arguments to be made right now on dollar. So we'll see how that plays out, but that's just a early forecast on what could potentially happen on dollar. But back to the Cayenne list, we just outlined why we would avoid that GBP 4-hour, because dollar was simply not ready, not in agreement. It was still drawing lower, which would mean why are we going to be bearish if we're also bearish on dollar, right? They move inverse. Now going on to Euro JPY. When do we force a bias? I did send a video on this earlier in the Trading Together chat. If you want to watch that, I believe it is also pinned, but I will walk that briefly through that here again, because the indicator that we have here, the IRL indicator, has a feature where we can force a bias, right? Currently, it's done automatically, so it'll automatically determine the bias based on where the order flow legs are pointing. But we can override that if we see certain signatures, which I'll outline right now, in price. We can override that to become bullish bias. And what this will do is it will now, on this time frame and all the time frames below, mark the bullish fair value gaps. So let's understand why we would first want to do that. And this goes back into the topic of candlestick logic, which I call CSL for short. Just reading the individual candles right here. If we go back in time right here, understanding how this monthly fair value gap is currently playing out. We came in and then we rejected. This creating in this candle what is most likely daily fair value gaps displacing lower, bearish daily order flow. We now want to see that continue pushing lower down towards that context low, because we have daily fair value gaps here. Any retracements in this candle should get rejected, pushed lower, and this next candle should follow through on what this candle did. That's not what happened here, right? And we're going to be able to see all this on the daily once we get down there, but we could also just see it straight up from looking at the monthly. Here's what happened on the monthly. Well, this candle swept previous month's low, so we're respecting a discount array, which is not good if we have a bearish bias, an idea. We want to see discount arrays get disrespected and premium arrays respected. Well, we're respecting a discount array, sweeping it, closing inside that candle's range, respecting because the body is closing above it, not below it. And what happens when we respect a discount array? Well, remember, price always goes from discount array to premium array to premium array to discount array. What is the next discount? Or sorry, what is the next premium array we can target right here, just based on this next candle? Because over here, I'm now leaning more bullish. Because it's very suspicious. If we're truly bearish, why are we not pushing lower on this candle? Why did we get so close to actually hitting context lows and then rejected so aggressively like we did here? This right here in this candle is likely to be daily fair value gaps now pointing higher, irrespective of discount array, a shift in lower time frame order flow to the upside, giving us this as our next draw on liquidity, as our next bias. We have a bullish bias up to the next premium array, which would be previous month's high. Right there. So in this next candle right here that's going to open in January, we can have a bullish bias targeting that high. And we want to confirm that with daily fair value gaps higher. Now, those daily fair value gaps higher will not show if the monthly fair value gap, if our bias right now is set to automatic and bearish. So what we want to do is set our bias to bullish. And as you'll see, it will delete that gap. And once we go down into the daily, all our bullish fair value gaps and weekly fair value gaps are going to be marked. Actually, go back to current price action right here. All our relevant fair value gaps are going to be marked, which we can now look at the weekly. And by the way, let me walk you through what happened on the daily. Remember, this is that bearish expansion candle we saw lower. If this next candle wanted to continue lower, if that monthly context wanted to play out, I wanted to see these fair value gaps hold. Why did we not hold? Why did we displace through them, creating new bullish fair value gaps and shift order flow? That's a red flag for lower prices. Not good. All right, sweeping previous candles low. Well, now we're likely going to seek a premium rate up there. Okay, so let's see what's happening on the weekly. We have a weekly fair value gap get created right here. And again, just to show you guys exactly how the indicator works, if I left this to automatic, you're going to see this gap disappear and you're going to see the monthly fair value gap. Boom. All right. You would be blindsided. You might still look for shorts just because price came into the monthly breakaway gap again, and daily gap lower means 4-hour gap lower, and we can short. No. That's completely incorrect because it's already mitigated and it's already used up. So once we come back here, well, if we want to continue pushing lower, we would need a new reason to do so. So if I want to look for shorts again, I would want to see at least a monthly swing high get swept, and then we can move lower off of that. But over here, we're moving lower off of nothing. This gap is no longer relevant for any reactions, rejections right here. Very important to understand right there. Now, again, just to show you, once we switch this and force the bias to change to bullish, weekly gaps are marked. That gap is gone. We can work with that bullish idea we determined. All right. And now, what do? Well, we have our bullish bias. We have our narrative. If we want to push higher, where can we move higher from? Weekly gap right here. Okay, cool. Beautiful. Answered number 1. Answered number 2. We have number 3 by just being able to answer number 2, because now that gives us the context to work with. IRA to era. Now we need the entry. All right, what's the entry? Well, from a weekly, we can look for a 4-hour. So let's look for a 4-hour fair value gap right here. Let's wait for the indicator to plot, and there it is, everything plotted. Beautiful. 4-hour fair value gap. Where can we enter? Well, we can enter right there. Oh man, it keeps doing it. Not cool.
You have to save the template when you make the adjustments.
That is a great idea. I will do that. That should work. All right.
That's the way to go. Is you don't change the price, but you change the ticks in the settings. So just set it to 10 ticks or whatever, or 100 ticks, and then save that.
Oh, yeah. Okay.
No idea if that helps, but I think so.
Yeah, that's good. So we can just save as tool, whatever. Okay, sweet. All right, that's perfect. So, all right, let's go back in time to where this entry setup occurred. Right, we have our weekly. We have, again, from the top, bias, bullish. Narrative, how are we going to get there? How are we going to work off of that bullish bias? We need a PDA rate in agreement with that. We answered that with that weekly fair value gap we just saw. Right over here. This is our narrative PDA rate. Context, from PDA rate to the other PDA rate, the opposing PDA rate. IRO to ERO. Push context, as I like to call that. Now, step 4, the entry. Off a weekly, we can look for a 4-hour impulse shift. Okay, 4-hour impulse shift. There's your fair value gap out. That is an entry already. So we can take our long position tool, enter right there. You put your stop loss at the swing low here or at the bodies, and target a static 2R. And that is your trade setup. We now have our bias, narrative, context, entry, and now all we got to do is manage the trade. So then I can put the stop loss. I'm already in. I don't want to see any entries. And I want it to trail based on the wick. So that is where I will now set my alert. This is replay. It won't let me, but I will set my alert there, and it will trail it based on the order flow legs. So let's see how this ends up playing out. So you see right here, let's go back in time a little bit. Went a bit too fast. So right there, you can actually trail your stop loss up. It is a bit aggressive. It's a bit aggressive. If you want to do that, you can. What I tend to do is I give it just a little more room, right? You wouldn't be incorrect by removing it here already once we get that new signal. But what I like to do is wait until this level, this last line of defense, is above my entry. So this low, I would like to see a new order flow leg with that low at least above my entry, because the reason for that is because it protects your position a bit more. It protects you from getting stopped out prematurely, because this level is a last line of defense. So what can potentially happen is we sweep a last line of defense to still continue higher. So when you have that last line of defense above your actual entry, for example, if we have something like this, you are protecting your trade from a scenario like that happening. So let's continue pushing higher here, see how we move along. Now right here, this scenario, once we had this fair value gap created, then I would go break even. I'm break even at that point. Okay, and now it is a free trade. You could even trail it up to that high as well. I tend to just go break even, but you can also trail it to that stop loss, protect your position, and be in profits, although small profits, which is for me why I would rather just go break even than taking a tiny win in case it wants to do something like that. I'd rather just get the break even. But again, that's all up to your personal preference, your risk tolerance. As we all know, trading is a very personal thing. So that's something that you have to determine. What do you want to do in a scenario like that? But I'm just giving you guys a bunch of options here that you can do. And overall, at this point, if you still haven't gone break even based on the order flow legs, now you should be break even based on proximity to TP. See how close we are to TP, how far we are from entry. It would be so stupid if you're not break even at this point and end up taking a full loss on a retracement like that. It just wouldn't make sense for price to do this anyways, right? That's super unreasonable. So you want to be break even there, even if you're not using the order flow legs. And as you can see, we swept the last line of defense right there and eventually went up and hit our take profit. All right, which is why I like to go break even and not, that was actually a great example right here. Why I would actually just stay break even and not consistently trail my stop loss up in profits and profits and profits, because now you're choking it. I like to at least secure a break even, and scenarios like this will happen where we now swing low and then continue pushing higher, which is exactly what happened here. So if you followed that all the way up here and trailed it to that level, that may have gotten you out prematurely just for you to get stop hunted and continue higher. So for me, I like just going break even at that level. Again, those are your options though. If you want to protect the trade aggressively like that, you can do that. But that is that. That is Euro JPY. And just a quick note on currencies here. Why was Euro JPY strong? Well, remember, we want to pair a strong currency with a weak currency or a consolidating currency. So if we look at Euro, been extremely strong. Bullish fair value gaps, large displacement. Compared to something like JPY, it's been weaker. It's been relatively weaker. Now, you might be wondering, which is something people get hold up on a lot, but we have a bullish order flow, like I'm bullish. Well, if you're relatively comparing that and seeing that compared to Euro, what is way more bullish right here? Euro. JPY, we're pretty much consolidating. We failed to expand above that swing high, above this context high. We swept back into the range. Well, now we're likely to consolidate. This daily fair value gap is no longer really an area that's super strong. We're weaker compared to Euro. Okay, great. Strong, weaker currency. You can consider this consolidating currency. Beautiful. Now we have a high probability pair. And it's moving nicely. Okay, compare that to something like CAD JPY. Why is CAD JPY moving like this? Why is it not as nice as Euro JPY? Look at the currencies. What is CAD doing? It's consolidating. What is JPY doing? It's consolidating. It's weak. Okay? Euro super strong. JPY is weaker or consolidating. CAD, JPY. They're not doing anything. You don't want to pair two of the same things. That is why something like CAD JPY is really gross. CHF JPY is not moving well. Well, why? It's relatively weaker compared to Euro. So we want to be focusing on Euro longs if we're going to be looking at JPY quotes, because we want to long the base currency, which is the strongest, which when doing our analysis here, we can determine that Euro is the strongest. GBP is also very strong. So let's look at GBP. It is moving nicely. But why did we focus on Euro JPY? Well, that just goes down to the higher time frame context, where we don't really have clean higher time frame context on GBP JPY. We're disrespecting that weekly gap. And we have a bearish weekly gap to the downside. So there's really nothing to base any longs out of. Whereas on Euro, we actually have weekly context that is good. NZD JPY, we don't have context. We are moving higher, but why are we not going to trade that? Well, there's no higher time frame context. Same with AUD JPY, no higher time frame context. Euro JPY, weekly IRO to Euro. Very, very nice. What time frames do you look for at currency strength? Same as your IRO trade time frame? Yeah, I really just stick to the higher time frames really on looking at the currency futures. The daily chart mainly. Daily and the weekly, just the higher time frames.
Quick question: will we have time for Q&A after, or no? Because
Yeah, we can do like a 10-minute Q&A, something short, because I have not eaten at all. We can do a short one. Okay. For sure. But I'm gonna get through these next examples so we can actually get that started. So that's Euro JPY, and that is that. So PNL, or sorry, Platinum. Why I wanted to go over this is an example of a low probability alert and a low probability conditions, right? So if you have been watching the IRL alerts, we saw this right here get alerted. Platinum 1 hour is rejecting a daily IRL. Why did I avoid that? Why would I avoid that? Why is it a low probability rejection? And why is it lower probability in general, these conditions? Okay, well, let's break that down. So the alert was a 1 hour from a daily, all right? We're going to get there. We have to first start on the monthly. Over on a monthly, we're not really going anywhere. We've been consolidating. As we can see, Platinum doesn't really like to have sustained price movements. There's really not much of a story I can determine on the monthly. So already I am seeing a red flag. This is our first red flag. Overall consolidation, nowhere, no fair value gaps on the monthly either. A lack of fair value gaps signals low probability conditions. It's a lack of order flow, right? So when you have no fair value gaps, you have low probability conditions. And we're seeing that right off the bat on the monthly. That's a red flag for me. Go to the weekly. Same thing on the weekly. There has been no weekly fair value gaps since, this is a tiny one too, I wouldn't even consider that, since over here, since last September. We have just been nasty. No sort of order flow, no intention to move anywhere. Again, that monthly consolidation can be seen on the weekly. Nasty, nasty business. I can't really determine what's happening here. Even on a weekly candlestick logic basis, we're just having an inside candle of this candle, which we're now inside of this candle, which we're just progressively just narrowing in this range, right? We're not even sweeping previous candles highs to work with. And now on the daily, let's turn off this alert and go back to automatic bias. We got to turn that back on to normal. We are getting the alert off of this daily breakaway gap. Well, can we trust this fair value gap right here? Because remember, monthly consolidation, weekly consolidation, daily, what is likely to be happening? Consolidation. Why can't I trust this fair value gap, right? This goes to the trust test we discussed earlier. Look to the left. Have bearish and bullish fair value gaps follow through? Well, this bullish fair value gap didn't follow through. This bearish fair value gap consolidated, and didn't follow through. This bullish fair value gap didn't follow through. This bearish fair value gap didn't follow through. This bullish fair value gap failed. Why are we going to trust out of all of a sudden, out of nowhere, this daily fair value gap right here? We can't trust it. It didn't come out of anywhere, and all the fair value gaps prior have been failing. So why is this one going to work? That's the trust test. We just can't trust it. So we had a 1 hour fair value gap lower. That was the alert. 1 hour is rejecting daily IRL. And if you took this, you would have taken a loss. Overall, just low probability conditions. You would have stopped that right there. Not something I would have taken. Bad. It's a bad trade. So that, simply put, is low probability conditions. Final example. Same thing, low probability IRL alert, low probability conditions. We also saw this alerted right there. Although this one did work. So I also wanted to go through that, because just because something works in low probability conditions doesn't mean you should do it again next time, right? We have monthly breakaway gap right here, or monthly fair value gap we're trading into. All right, that's not too bad. But on the weekly, we have an extremely strong retracement there, creating a weekly fair value gap, which we are currently respecting based on the way this candle is forming with this large upper rejection wick. There's going to be 4 hours left on this candle. It's likely we close like this. So while we're respecting a weekly discount array, respecting previous week's low, that's a red flag. That's not 100% bearish argument, which is what makes up high probability conditions. 100% bearish arguments or 100% bullish arguments is how you get those high probability trades. So off the bat, I just don't think this is high probability, because there is this weekly fair value gap displacing so aggressively. There's some red flags here that make me feel uncertain. So in a scenario like this, goes back to where I would want to demand more confirmation, where I want to see a new daily fair value gap created off of this one. So I'd want to see new expansion lower, disrespect that weekly gap, and then I would look to play something like this, and then this becomes my high probability context right there. But I avoid this initial one. Regardless if it plays out or not, it doesn't matter to me, because what you'll notice is this one actually did work out quite nicely, where we had that 1 hour fair value gap, impulse shift, and it followed through right there. Again, I'm waiting for more confirmation, and you don't want to get into a habit of taking low probability trades, because in the long run, that will give you unprofitable results. So that is another example right there. And finally, done with all the examples, we can have a little Q&A right here and answer some questions. So I hope that was insightful, that overall breakdown of everything. Let's see. Yeah, monthly still forced to both sides. How do we know when IRL is going to be disrespect and become a flip? That's a good question. What we don't have to do is wait for an entire close. So let me look for an example right here. On let's take this for example on dollar. We had this monthly fair value gap right here that was failing, and actually go back in time to right here. you can determine that is going to fail before it closes, right? So for example, what this monthly candle is currently doing, we're trading very aggressively through it right now. Pretend this candle's live. Trading very aggressively through it. We haven't closed. We still have a couple weeks until the candle closes. But what is the lower time frame for value gaps telling us? Well, on the daily, we are displacing super aggressively right through it, closing below it, huge displacement, just slicing right through it. At this point in time, I can lean into the higher probability that that monthly gap is going to fail because of the lack of respect, how strongly we're displacing below it. Bearish for value gap right here. I can look at that for shorts. And now, again, the monthly candle still hasn't closed and officially disrespected this bullish gap. This is November 20th. We still have about 10 days left in the month. We can already start looking for shorts. We don't have to wait for that candle to close. We don't have to wait a whole month for candles to disrespect. We can already play the lower time frame order flow, signaling how we're already disrespecting that level. So right here, this daily for value gap below that monthly, that's good to short. And bam, that's great. And yeah, it's pretty much in a nutshell. You do not have to wait for it to close. Just observe lower time frame order flow. Is it displacing right through it? Is the candle right there showing any sort of respect to that level? And it's not. All right. Next question. For overlapping swing highs or lows, do you wait for the touch of the overlapping level, or does it or does it matter? Are you talking about like for an entry? Like if I wanted to enter off of a overlapping high or low, what specifically do you mean?
Was a question from Jacob in the chat, but I think in general, so when, let's say there we have an overlapping high, and if you would want to look for a buy from the zone, would you wait for the touch of the overlapping high, or does it simply mean it's a higher probability entry?
Oh, okay. Yeah. So these are just lines of defense where we can expect a potential entry function to occur. So we as traders, we don't know where that's going to occur. We just know the hotspots for that to occur. So if we just come into the first line of defense right here, for example, this fair value gap, we get our entry function right here, daily fair value gaps higher, we can already look to trade that. But if that doesn't happen, or if that does happen and still fails, well, we have another opportunity to push higher off of the overlapping level. So that's, yeah, another line of defense. We can hunt for an entry function, a impulse shift, for example, and look to trade that. So what essentially, we are waiting for that lower time frame order flow confirmation at either the first line of defense or the overlapping line of defense. And based on when the order flow shift happens is when we can say, okay, we're likely moving off the first line of defense. That never happens. Okay, we're likely moving off of here. And if that doesn't happen here, well, then we're likely going to seek opposing liquidity at this low. So that's failing to offer fair value, likely seeking liquidity. So let's see. In the beginning, you showed a trade with a chain entry on the 4-hour, I believe on gold. Yes, let's pull that up. It was on gold. Can you show the difference when you would have waited for the daily? Okay, that's a great question, actually. I actually wanted to talk about that. Forgot to speak on that. Thanks for reminding me. So we were talking about, I believe it was it this chain entry? Let me go back. Let me get out of here. I believe it was a 1-hour chain entry, though. No. I don't know. I lost it. But anyways, when would you go for a chain entry or go over a daily? Well, that option is entirely up to you. Really is. You can, or for example, what I do is if we have a monthly fair value gap, what you can do is either wait for the daily fair value gap, or if you get the 2 4-hour fair value gaps first, you can just look to trade that. I really just go off of whatever forms first, because if we have a daily fair value gap, then it's also likely we already have a 4-hour chain. If we have a 4-hour chain, then it's also likely we get a daily fair value gap. So for me, I just see, all right, whatever happens first, they're just as equally valid. So what I would do is, for example, I think a better example would be if we have like a weekly, because from a weekly, we could already take direct entries off of the impulse shift or the 4-hour chain. So if we had like a weekly fair value gap, and we can look for either a 4-hour fair value gap out, 4-hour impulse shift, or we can look for a 1 hour FVG chain. What I would do is simply whichever forms first, I'm taking. So there are scenarios that you'll see where the 4 hour for Valley Gap doesn't form, but the 1 hour chain does. Or the 4 hour or the 1 hour chain doesn't form, but the 4 hour gap does. So what I do is whichever forms first is my entry off of a weekly array. So that's simply set. What you could also do is you can just focus on one, be a master of one of these. Always look for a 4 hour off a weekly, or always look for a 1 hour off of a 1 hour chain off of a weekly. It's up to you. And yeah, find whatever works best for you. Or if you want to use both, that's how I do it. I was late. I missed the invitation. This meeting is recorded. Will the recording be shared? Yes, it will be shared. It will be shared. And what if there's opposing PD array like a daily into a weekly? Well, in that scenario, for example, let's say we have a weekly, we have a daily. I would want to see more confirmation. Or, for example, if we have a daily here and the 4 hour impulse shift is very aggressive, completely overrunning the daily on its own, I would look to just take that regular 4 hour impulse shift right out of there. It's already showing disrespect to the daily. I will take that. But if the 4 hour impulse shift is down here, there's actually a few scenarios you can actually play with this. And if you can get 2R from all right, I'm gonna have to fix this tool when I have more time. It's gonna be so much problem. If you can get 2R from this entry up to that daily for Valley Gap, well, now you're working in still low resistance conditions. Once you get to that daily, then you can expect some sort of retracement or consolidation. But if you can get 2R off of that 4 hour impulse shift inside this weekly context up to a daily, that's also valid. If the daily is really close like this, I tend to just wait for that daily to get disrespected first, and then look for an entry. So more confirmation, meaning I want to see this daily get disrespected. I want to see new 4 hour for Valley Gaps created right here. I'll wait for a weekly to 4 hour chain. That is how I will operate. Thanks for the info. So this is Ion price doesn't sting into the weekly heavily, right? And respecting a premium rate. This is if a price doesn't sting into a weekly heavily, right? Yeah, so this is like a simple high probability IRL to ERL, a nice light tap, something like this. We come in, let's say this is a weekly. I'm looking for either a weekly 4 hour impulse shift or weekly 1 hour fair value gap chain, weekly 1 hour fair value gap chain, something like this, which is it is a really ugly drawing, but just to clear it up right there. All right. Any other questions? Or else we'll start wrapping up here and closing up shop. I think we went through a lot. I think I answered a lot of your guys' questions based on everything we went through. So it totally makes sense. Totally okay if there's not much left. We'll give it another 30 seconds here. We'll wrap it up.
The ones from the chat that I sent you privately, did you have?
Oh, yeah. Let me take a look at those. I'll answer those right now, actually. So does the day of the week matter? So we have some questions here that I was sent in chat, guys, in case you're wondering. Question 1, does the day of week matter and week of month? When swing trading, it does not really matter, right? You can take a swing on a newsless Monday. Totally fine. Does the week of the month matter? It doesn't matter. So here it says, example, we are currently in the 3rd week of the month. Does that matter? It doesn't matter. It's totally fine. You can take a swing when price action is looking good. The economic calendar agrees with that as well. More so the day of the week matters when you're intraday trading. That's when you want to be cautious of the day of the week. For example, we went earlier in the stream, if you guys remember, NASDAQ, right? I talked about it today, why I was not expecting expansion today, because Fridays typically have this characteristic where it closes the weekly range, retraces, forms the upper wick of that weekly candle, and it's low probability to see continued expansion, especially after we have seen so much expansion all week. It's very low probability this continues expanding on Friday. So that's where days of the week do matter. Or on newsless Mondays, they typically are lower probability. Then weeks of the month, I don't really worry about weeks of the month. Now, question right here. Big three news events: FOMC, NFPA, CPI. Can we swing trade through them? For USD, FOMC, NFP, and CPI, I don't like swinging anything through those big three news events. Those are crazy. I've had good experiences with swinging, and I've also had bad experiences with swinging where I've been slipped a lot. And for me, it's not worth it to open up the door to potential slippage on a USD red folded news event. So what I do, but the question right here is, what about events like AUD CPI or CAD CPI, GBP CPI, or just any other CPI that's not USD? For those, you do have a green pass to swing through them. They're not as aggressive as USD. They are still very aggressive, don't get me wrong, but they're not as aggressive. And if you have a very safe 4-hour entry, 1-hour entry with a 1-hour swing point stop loss, 4-hour swing point stop loss, which naturally is going to be a lot of pips between your entry and stop loss, then you are protected. More than likely will be protected for that volatility. Now, what you don't want to do though is trade a 1 minute, for example, AUD JPY. You get in on a 1 minute trade 10 minutes before AUD CPI, because now you're operating with a 1 minute entry and a 1 minute stop loss, and now that CPI is going to absolutely slip you because you have a tiny stop loss in terms of pips. But when you're swinging, you have a 4-hour stop loss or a 1-hour stop loss, and you're just overall protected more because you have more pips between your entry and stop loss. So yeah. And question 5, you often say, if not comfortable, seek more confirmation, more FEGs to form. If we wait for a new fair value gap to form, isn't there a risk of potentially buying too high or selling too low? That depends on the scenario you're in, because yes, if sometimes that does happen. Most times for me, I haven't really had an issue with that. It's if you can't frame your 2R off of that second leg entry, like for example, your second leg entry is right here, and now you're ending up with a 2R target, for example, somewhere up here when we do the position tool, which again, it's kind of broken for me today. I'll fix that later. It's tough. Now that's a bit of a lower probability trade because you're demanding, remember what we talked about earlier, the stages of probability, stage 5 of expansion through context. So in that scenario, when your FEG chain entry is very high up in a premium, it becomes, it does become difficult. But again, this happens in different scenarios, right? It's not a every time thing or guarantee. But yeah, like you're right. Sometimes it does get too much in a premium where now you're demanding so much above context highs. But there are also many times where it's perfect for 2R within the context. So you just have to judge that based on the specific scenario. That's how I would approach that. So I believe that's all the questions he asked right there. Euro JPY. How are you drawing the second buy side liquidity above the context area on the weekly chart? Let's see what happened on Euro JPY. On the weekly? Are you talking about this? Are you talking about this high real quick? This high I'm marking out? Keith? Hang. Yes. All right, yes, that went back to the monthly idea right here, where we are now targeting premium arrays because we're respecting a discount array. So the immediate draw, yes, would be previous month's high right here. But then what is right above that? What's the next likely draw at that point? If we're taking this high, well, is it likely we do something like this and this reverse? Not exactly. We have a monthly swing high right here, and that's a very strong liquidity pool. It's a target we can have, right? Target the premium arrays. Well, this is one and this is one. So if this hits, this is likely hit. So I'm just marking up the closest premium arrays, which is this monthly swing high. Candle lower to the left, over to the right. And that's how I got to that right there. So we have 2 potential targets, which is why, I mean, if we're targeting here, we're likely just going to target the ultimate liquidity pool right there. So that's why I simplified it, refined it, kept that high. Yes. Would you continue play order flow legs on lower time frame context, like a daily context being disrespected? No, it was manual. It was manual. Yeah, all good. Would you continue playing the order flow legs lower on lower time frame context, like a daily context being disrespected? Are you talking about like a flip context, for example? If we had like a daily fair value gap right here, currently getting disrespected, and then play like the lower time frame 4-hour gaps lower. Yes, flip. Okay, yeah. Then yeah, if we're currently disrespecting that daily, I would be looking at 4-hour gaps or higher probability if you look at 4-hour gaps right there, and then you can short that. If we're currently disrespecting, could be good, could be nice. That is fine. That is flip context, yes. But yeah. Will you wait until the 4-hour gaps closes outside the fair value gap? Yeah, that's what I typically do for the highest confirmation. We could also be overlapping it like this. Something like this, I'd prefer to wait on. I'd rather have it over completely over that closing above it for the highest probabilities. But yes, that is that. We're going to close the Q&A right here and end the session. So I hope that was insightful. And please, if you have any further questions on the indicator, look at the start here section on the Discord. Everything is there. So yes, I actually just realized now I wasn't recording on my end. So I really hope that was a recording on Google Meet.
I recorded locally and on Google Meet. So
Okay, perfect. Thank you. All right, so yeah, appreciate you all for tuning in. Appreciate you. Yes, I will enjoy some grub right now, Dev. I'm starving. But yeah, I really hope that was good. And any further questions, let me and Nils know. We are in the Trading Together chat, the tech support chat. We are here for you, and we will help you with whatever you may need. And yeah, hope you have a great weekend, guys. Thank you. Get back.